Good morning and welcome to the B.F. Anderson Technical Report for June the 30th. Look, Peter Lynch, the great manager of the Fidelity Magellan Fund, back in the 1970s, caught that low, that market low in 1974, started the Magellan Fund, made history, one of the top performing mutual funds of all time. So Peter Lynch is definitely the great teacher. He has experienced things that we have not, and he wrote a book about it. And the book is called One Up on Wall Street. You know, the title of the book basically says it all. It's saying that you, as a small individual investor, have something one up on Wall Street, which he's trying to get across the point that big is bad, small is good. So if you think about Lynch's history, he retired fairly early in life, mainly because I believe that his fund grew to such a proportion relative to the market that he lost his edge. See, one thing about big investing funds, mutual funds, hedge funds, etc., they have something that the small investor doesn't have to worry about. It's called liquidity risk, meaning that you want to take on a substantial position in a good investment and you can't do it because you will run the price up, or if you want to liquidate or get out of the position if you're wrong, there's not enough liquidity in the stock to allow you to do that. But the small investor really doesn't have to worry about such things. But let's look at a couple of quotes from the book. The first quote is, "The key to making money in stocks is not to get scared out of them." What we're talking about is the enemy. The enemy is volatility. When you have volatility and sideways markets and even down markets or bear markets, investors generally get scared out of them at the wrong time. They come in at the wrong time and they get out at the wrong time. The best thing to do is to learn how to have a discipline and a system, which I'll talk more about as we get into the video. Second quote, "Owning stocks is like having children. Don't get involved with more than you can handle." This kind of falls along the same lines as Warren Buffett. You know, Warren Buffett's of the opinion that by the way, Warren Buffett is referred to as a focus investor, where you focus in on a few things. You don't want to focus in on too many things. You want to get very competent at what you're dealing with versus trying to spread your risk. In other words, there's a real problem out there as far as I'm concerned with over-diversification. So what Lynch is trying to say there is that zero in on just a few things and focus. Last quote, "You can find good reasons to scuttle your equities in every morning paper and every broadcast of the nightly news." Again, there are enemies out there, and the enemy is volatility, and the enemy can be the financial media, the talking heads. They can really confuse you. Be aware of that. Now, let's get into the charts here. I wanted to bring everybody up to date. The most important thing that I'm noticing right now is an improvement in the Russell 2000, which is a small cap index. The small cap stocks are actually starting to outperform here. They're not breaking out, but I would say that you should watch the level on the Russell of around 425, 430. A breakout above those levels would be very, very positive, because if we can get the small cap stocks working and the mid cap stocks working, it's telling you that the economy is really improving. I'll talk more about that as I get to the end of the video. One thing I do want to remind everybody about is something called the 7.5% rule, which we hit on February 27th, right here. Now what this is called a blast-off indicator. It came right after the first of the year, January, then we got into the end of February. What the rule is basically this, that when the S&P 500 rallies above the 35-week moving average by 7.5% or more, that is what we call a blast-off. Now this has only happened 10 times since 1980, so this is somewhat of a rare occurrence. But, the history has shown that the average gain in the following year is about 21%, so it's worth noting. Also, once you get this blast-off indicator, you tend to have very minor pullbacks. So you can see here, we got the blast-off indicator, had about a 2% pullback, but now we're making new highs. So the 7.5% rule so far is in place. Now, we talked about Peter Lynch, and we talked about volatility. The whole name of the game is to understand that what we have gone through from 1998 to 2013, 2014, this is a very rare event. This has only happened 2 other times in the last 100 years. The last time we got a sideways market like this for such an extensive period of time was 1929 to 1942. The other time would have been 1966 to 1983. And as you can see here, unfortunately the graph does not go back that many years, but we can see here the breakout that took place in 1983. Now the key to understanding volatility is most people will not come into the market until you're at the upper end of the price box. Then we'll get the sell-off, the consolidation, and they tend to want to get out here. Look, I've been doing this for 40 years. I see this over and over and over again. Then we'll get a rally, everybody gets interested again, they come in at the top of the price box, then they get out. They get in at the top of the price box, then they get out. This is futile. You cannot do this. This is the biggest mistake investors make. You need to do trend following, which means you need to understand that this index is in a long-term uptrend and you're going to have these consolidation periods. So like even recently, we finally broke out of this extensive consolidation box, and I'll repeat, this has only happened 2 other times in history. So we've now gotten the breakout, but then we went through the first consolidation phase. I found it very difficult. It was very difficult. We had a lot of new investors come into us at this area up here, and as we got into this area down here, they lose interest. Now we're starting to see things picking up again. Do we go into another consolidation phase? Possibly. We don't know. The thing that you have to realize here is to get from point A, which was 1,000 on the Dow, to point B, which was 12,000 on the Dow, 12 times your money over a period of time, you had to go through 1, 2, 3, 4, 5 major consolidation phases. Now, what tools could we use to help us with this? Well, it's moving averages. If you use a moving average, it tends to smooth the volatility out and give you a better feel for what's truly going on. Now, at the beginning of every report that we have that comes out on Thursday, which is the market report, we have a graph on there called the 10-20, which is a 10-month moving average versus a 20-month moving average. I got this idea from Luis Yamada, who is a very competent technical analyst who has back-studied this stuff extensively, and basically has determined that 10-20 is one of the best ways to look at this thing. So if you realize that you're looking for crosses, death cross, golden cross, death cross, golden cross. So you can see here, this is the big culprit. This is the big problem. And this is the and then here too, you can see we had a very difficult period here. So the thing to do is just to realize that this is probably not going to happen again in our lifetime, but again, we never know. But Janet Yellen came out the other day and said that we'll probably never see another bank problem like we had back in 08, 09 in our lifetime again. Usually these things do not repeat, but this was a very difficult period that is now appears to be over, and we're back on a buy signal, so everything looks fine. But if you use this concept, you can see where you take 5 instances and you really narrow it down to about 2. So you're increasing your odds of being able to get from point A to point B dramatically. Now you could even take it another step. Now, again, this is for illustrative purposes only. This is not what we use, but I'm trying to illustrate to you the power of a moving average. If I take the 20-month moving average only, and I just draw a trend line, which is connecting the lows, you can see that if you just use the 20-month moving average during the 83 to 2000 period, you would have captured all that gain without worrying too much about the volatility. But this is of course easier said than done. Now I wanted to get into the top 5. There have been some changes here. We're still seeing a lot of technology names. Here's the one of the stocks that makes top 5, which is Alibaba, which is the Amazon of China. Continues to look fine. Moving averages are all in uptrends. Stock is somewhat consolidating in here. I continue to like the stock. Now, here is a biotech stock. Now, I want to mention something about biotech. Biotech is a risky place to invest. You know, it's almost like you need to really make it an area that it's all that you do, because you need to be involved in the medical industry and you need to understand what's going on. But it is a risky area, and I never say never. I mean, I will definitely look at these stocks. But if you think about what I just showed you, I showed you Alibaba, which is China, and now I'm showing you a biotech stock. These are somewhat of the risk-on areas of the market. Now, I'm going to show you at the end of the video a couple of risk-off concepts, but in other words, when risk is on, it means that the market is discounting that the economy is gradually getting better and people are more willing to take on risk. Now, another stock that we're involved in that I would just point out to keep an eye on, I would not buy this stock right now. It is kind of acting a little bit on the weak side. We may be seeing some rotation in the market. Again, I'm going to mention that. This is Shopify, which is an interesting company that's in a partnership with Amazon and Facebook having to do with e-commerce. Again, we mentioned Tesla. It continues, hit an all-time new high here recently, has pulled back with the market. However, holding the 25-day moving average continues to look promising. Now, here we have another stock that's a biotech. Here's the biotechs. Again, we're starting to see these risk-on type of concepts. Let me jump here to the next page. Now, I wanted to mention as a close, we're seeing some rotation in the market right now that I think is very positive. This is the financial stocks. This is the banks primarily, the banks and the insurance companies. Why is it that all of a sudden here, these stocks are starting to break out to the upside? Now, like I mentioned last week, the big problem with 1929 was we lost the banking system. In 2008, we came close. They saved it with the TARP program, and it looks like to me the banks are pretty much in recovery, which tells me that the economy is getting better. But I think even more importantly, I think this rally has something to do with interest rates, because the bank stocks and the insurance stocks kind of trade like commodity stocks, like oil stocks. If you get a rise in interest rates, their profit margins go up. So basically, is this telling us that there's a possibility that interest rates are going to start climbing? We'll see. But here's another one just to kind of be aware of. This is the utility stocks, the electric utility stocks, which act like bonds. Well, man, they're breaking down. There's a double top in here. You're breaking down below the 50-day moving average. Market's making new highs. These stocks, meaning utilities, are very interest rate sensitive. So if interest rates are going to climb, the utilities are discounting this. So if you have any questions, give me a call. A lot going on. Thank you.